The S&P 500 is now up 20% this year. Wow. But, that's the past. You probably care more about what is ahead. So let's kick it off. On set, Unlimited CEO Bob Elliott and Main Street Research CIO James Demmert. Welcome to you both, guys. Working hard on a Friday. Bob, I'll start with you. You are here. Been a great year so far. Past is the past. What do you see for the next 3.5 months, 3.25 months?
Well, I think the biggest thing that we've seen over the course of the last couple of weeks is the Fed making the decision to ease aggressively into a relatively strong economy. And
yeah, I found that a little weird.
What we've got confirmation of GDP prints at 3%. We had another revision which highlighted the fact that income growth is growing at 7% nominal, and the savings rate has been rising for households. And as a result, you put that together, that's the sort of economy that is quite strong and powering ahead and can do that quite sustainably. And so the Fed cutting into that, in some ways buttressed by the fact that we are getting some low core PCE readings that we got today, that's just going to add additional rocket fuel to what is already a relatively strong economy.
I think the last time, James, that we've gotten, if you know, correct me if I am wrong, the last time we got this size of a rate cut, 0.5 point into an otherwise, at the time, strong economy, I think was in 2007. So like 17 years ago. You don't have to revisit the Fed. The decision has been made. But how much did that kind of add that gasoline to an already hot market, if at all?
Yeah, happy Friday, Brian. And I remember that 07, and that was ill-timed. I think they wish they could take that back in hindsight. But this is a different story. We're sort of now at the beginning of a business cycle, beginning of a bull market. And like your guest has mentioned, you've got a Goldilocks type of setup here, and that is going to create some rocket fuel. What I think is really interesting here as well, which is different than 07, is, the average stock, if you take away the Magnificent Seven, it's at 16.5 times earnings, which is historically cheap. And you've also got $5 trillion outside the market that should be in it, what I call FOMO fuel, an economy that, seems to be running along at a nice pace. I think here the risk is the Fed goes too many cuts and brings that inflation back. So investors should be careful here and maybe use that volatility that comes from it maybe to add stock.
Things have been good. James, I'll go back to you. Okay, things have been good. Fine. But the market is based on a couple of things: earnings expectations, and valuations. All the underlying stuff that Bob just talked about factors into those things, but the reality is earnings and valuations matter at whatever, 23 or whatever number you have times forward earnings on the S&P 500. A bunch of big economic reports coming out next week. Are we priced too much to perfection?
Brian, I don't think so. I think investors think that we are, and that's why we see a lot of people not fully invested. And this is common in the beginning of a cycle. The psychology, you can't really get in line with where those expectations should be. And you've seen that for the last 18 months. Earnings estimates continue to be moved up because they're too low. And we think that's going to continue for the next 4 quarters. But what's really interesting about this market, where the real opportunities are, is the earnings are way underestimated outside the Magnificent Seven. For the other 493 stocks, we think estimates are too low, and that's where you're going to see some big upside surprises.